Our topic today is the three R's: Rupee, RBI and recession. The currency markets have been reflecting serious economic turmoil. The dollar is still surging to fresh 20-year highs. The index is 107 plus, indicating safe haven buying on fears of recession. The rupee has had a challenging last few weeks and continues to sag despite Reserve Bank of India's steps to allow more foreign flows. The rupee has actually replaced inflation as the top policy priority lately. The rupee's biggest problem is the widening current account deficit. But with commodity prices falling and with both inflation, will both inflation and the rupee get a bit of a respite? Or will global recession actually compound our current account deficit problems and our rupee problems? For all these questions, I have with me two economists, Chetan, Ahya, the Chief Asia Economist at Morgan Stanley, and Sonal Verma, Managing Director, Chief Economist, India and Asia ex-Japan at Nomura Financial. Sonal, Chetan, thank you very much indeed for joining me. Tense times as far as the external sector is concerned for us. Now, the rupee has been under pressure, the RBI has acted, but if you look at the way the dollar index is continuing to surge and crude is not falling along with other commodities as much, Chetan, first to you. Do you think this pressure on the rupee is likely to continue? Pressure on rupee and current account deficit?
Yes, that I think to the extent to which I think global concerns on growth and US and Europe recession fears are likely to stay in the near term, I think this pressure on emerging market currencies, especially Asian currencies and INR, is likely to stay with us for a few more months.
But is it likely to get destabilizing? I mean, a lower currency, 79 or 80, is per se a correction of current account deficit. So do you think it is a handleable problem, or can it get a little destabilizing, Chetan?
I think it should be manageable, and to the extent to which it is not idiosyncratic to India, or even for that matter, specifically to Asia or emerging markets, it does seem more like a global rise of the dollar, and then so rupee has to depreciate. There is no choice for the central bank but to let it go. I think the only concern that the central bank would have is that would this add to inflationary pressures? And remember that that's been the challenge that the central bank has been facing in the background. But to the extent to which oil prices are coming off and commodity prices are coming off separately, and we can discuss that more later in the discussion, but we've also come out with a report yesterday where we see now reduced inflation upside risks for Asia. So I think to that extent, that inflation risks are manageable with commodity prices coming down. I think RBI can let the rupee go in line with the rest of the region.
Okay, so your expectation is what, 80 or even more?
Well, it's hard to give you a specific number. I think it all depends on the way the dollar goes. But it's very, as I mentioned, I think the near-term depreciation risks are likely to prevail.
Okay. What about you, Sonal? First of all, welcome to the discussion. Your sense, the current account deficit at it's not current account, sorry, trade deficit at $25 billion plus every month is kind of a new high for us. People are talking about 3.3, 3.4% current account deficit. What are your estimates, and is this likely to be a slightly more serious challenge, the current account deficit?
Yeah, Lata, broadly, we are expecting the current account deficit FY23 at 3.3% of GDP. So that's like $120 billion US. And in terms of the trade deficit, the widening we have seen is most likely to continue, because so far actually it has been driven more by commodity price inflation and increased volume of commodity imports, particularly the ones that are more inelastic. Whereas going forward, our view is that there will be a material slowdown in exports. We are in the camp where our baseline view now is a recession in US and many other advanced economies. So that will reflect in the export growth numbers coming off. And on the import side, the demand for coal, gold, despite the increase in import duty, the broader view is the current account deficit next 6 months remains around 4% of GDP, and for the full financial year at 3.3% of GDP. So on the whole, the pressure will remain towards currency depreciation in this broader global environment. Having said that, Lata, I don't think, this is clearly very, very different from 2013. India and INR does not stand out within Asia as having depreciated more. So it's very much in line with what we are seeing. And given the FX reserve position and various other tools that the RBI could come out with, it will be, in our view, a managed depreciation. So we are expecting further depreciation to around 82 by September and about 81 by December.
Okay, so 81 about the worst. No, I take your point. In fact, as both of you have been saying, the rupee is actually a better performer if you looked at all the emerging and even developed market currencies. It's just that it captures the public imagination over here and looks like a worry, whereas actually it may be helpful for many companies if the rupee were to depreciate. So now let me come to the other issue. I was going to broach this issue of recession. Sonal, what are the other ramifications for a country like India if your base case of recession actually plays out?
So our base case of US recession, so just to put some numbers, we're looking at minus 1% contraction in US GDP growth in 2023 compared to about 1.8% this year. This will, of course, have implications globally in terms of the export slowdown. Clearly trade volumes are going to slow down. And there are other regions in the world facing their own challenges in terms of the energy crisis in Europe. So it's not just the US. We are also expecting a recession in Euro area, UK, a mild recession in Japan, Australia, New Zealand, Canada. So it's basically a number of economies and, of course, the US. Now, in terms of what it means for India, I think first and foremost, what it implies is that we are most likely peaking in terms of India's own growth cycle. So growth momentum, of course, remains quite strong. The services side is picking up. But our view is over the next 12 months, the export cycle, the investment cycle will start to move lower. So we've cut 2023 calendar year GDP growth for India from around 5.5% to about 4.7%. So that's the main channel of impact. Second is in terms of how much disinflationary forces we see. The energy side had been relatively elevated despite growth fears. We've starting to see some moderation there. On the whole, our view is inflation for India will remain on the sticky side in the near term, particularly FY23, but the FY24 inflation outlook starts to, at the margin, look slightly better.
Okay.
So I think, in terms of the bottom line, Lata, is more in terms of incoming growth concerns from a more medium-term perspective, not immediate, but medium-term.
Okay. Yeah, I do notice that your growth forecasts for 24 are